The perception that the wealthy never pay taxes is a common misconception that often stems from a lack of understanding about the complex and legitimate tax strategies available to high net worth individuals. While it's true that affluent individuals have access to a range of legal avenues to minimize their tax liability, these strategies are not about evading taxes, but rather optimizing their financial positions within the framework of tax laws. In this article, we'll delve into how the rich legally navigate the tax landscape to reduce their tax burden while staying compliant with the law. Understanding tax planning. Tax planning is a crucial component of financial management for individuals at all income levels. It involves strategically arranging financial affairs to optimize tax benefits while adhering to applicable tax regulations. The wealthy engage in sophisticated tax planning to leverage legal provisions that enable them to retain more of their income and wealth. 1. Strategic use of tax-advantaged accounts. One of the primary ways the rich minimize their tax liability is through the use of tax-advantaged accounts. These accounts offer tax benefits, such as deferring taxes on contributions or enjoying tax-free growth. High net worth individuals often contribute the maximum allowable amounts to accounts like individual retirement accounts, IRAs, 401(k)(s), and health savings accounts, says. 2. Capital gains tax optimization. Capital gains tax applies to profits earned from the sale of assets such as stocks, real estate, and other investments. The wealthy strategically time the sale of assets to qualify for long-term capital gains tax rates, which are typically lower than ordinary income tax rates. By holding assets for more than 1 year, they can significantly reduce the tax burden on their investment gains. 3. Tax loss harvesting. Tax loss harvesting is a strategy where investors deliberately sell assets that have decreased in value to offset capital gains and reduce taxable income. The rich use this method to optimize their investment portfolio by offsetting gains with losses, ultimately minimizing the amount of tax they owe. 4. Charitable giving and donations. The wealthy often engage in philanthropy and charitable giving to reduce their tax liability while contributing to causes they care about. Donations to qualified charitable organizations are tax-deductible, allowing high net worth individuals to lower their taxable income. 5. Estate planning and gift tax exclusions. Estate planning is a critical aspect of tax strategy for the wealthy. They leverage strategies like gifting assets to heirs to take advantage of gift tax exclusions. By staying within the annual and lifetime gift tax limits, they can transfer wealth to future generations without incurring excessive taxes. 6. Family limited partnerships, FELPs, and limited liability companies, LCs. Family limited partnerships, FELPs, and limited liability companies, LLCs, are legal structures that enable the wealthy to consolidate and manage assets while minimizing gift and estate taxes. By distributing assets among family members and taking advantage of valuation discounts, they can pass down wealth more efficiently. 7. Real estate depreciation. Real estate investors can utilize depreciation as a tax-saving strategy. Depreciation allows property owners to deduct a portion of the property's value each year as a non-cash expense, reducing their taxable income. 8. Business expenses and deductions. High net worth individuals who own businesses can capitalize on a wide range of business expenses and deductions to reduce their taxable income. Proper documentation and adherence to tax regulations are key to successfully leveraging this strategy. 9. Tax credits and incentives. Tax credits are dollar-for-dollar reductions in tax liability. The wealthy explore tax credits and incentives available for activities like energy-efficient home improvements, adoption, and education expenses to lower their tax bills. 10. Retirement plan contributions for employees. For business owners who employ themselves or their family members, retirement plan contributions can provide significant tax advantages. Contributions to plans like a SEP IRA or a solo 401(k) not only secure their financial future, but also reduce their taxable income. 11. Utilizing trusts. Trusts, such as irrevocable life insurance trusts and grantor retained annuity trusts, GRATEs, offer opportunities for the wealthy to transfer assets while minimizing gift and estate taxes. These legal structures provide control and flexibility in managing wealth across generations. 12. International tax planning. Globalized wealth often leads the rich to engage in international tax planning. This may involve utilizing tax treaties, offshore accounts, and other legal mechanisms to manage cross-border investments and reduce tax obligations. 13. Hiring tax professionals. High net worth individuals typically employ tax professionals, including certified public accountants, CPAs, and tax advisors, to navigate the intricacies of the tax code and ensure compliance with tax laws. These experts provide tailored advice, maximize available deductions, and identify opportunities for tax savings. 14. Legal structures for investments. The wealthy utilize legal structures like partnerships, corporations, and limited liability companies to manage and hold investments. These structures can offer tax benefits and liability protection while optimizing overall tax liability. 15. R&D tax credits and business incentives. For business owners engaging in research and development, R&D activities may qualify them for valuable tax credits and incentives. These incentives reward innovation and technological advancements, further reducing tax liability. 16. Minimizing state and local taxes. The wealthy often explore residency options and geographic locations to optimize their exposure to state and local taxes. Establishing residency in states with no income tax or lower tax rates can significantly impact their overall tax burden. 17. Legal strategies for investments. Investments in tax-efficient assets such as municipal bonds or tax-advantaged retirement accounts are key components of the rich's tax strategy. By aligning their investments with their tax goals, they can maximize after-tax returns. 18. Continual monitoring and adaptation. Tax laws are subject to change, and the wealthy consistently monitor developments to adjust their strategies accordingly. They remain proactive, adjusting their financial decisions to leverage new opportunities and minimize tax implications. Ethical considerations. While the rich utilize these legal tax strategies to minimize their tax liability, ethical considerations come into play. Critics argue that such strategies contribute to income inequality and place a heavier tax burden on the middle class. Advocates of tax reform emphasize the need for a fair tax system that ensures everyone pays their fair share while reducing complexity and providing equal opportunities for wealth accumulation. Final thoughts. The perception that the rich never pay taxes is a misconception rooted in a lack of understanding of the complex tax strategies available to high net worth individuals. While these strategies are legal and well within the boundaries of tax laws, they do raise important ethical and social considerations. As discussions about tax reform and income inequality continue, it's crucial to recognize the intricate relationship between tax policy, wealth preservation, and societal impact.